So in terms of that one payment made just in time, there's another one due soon. We can assume somehow they'll make it again. But to what extent does this reassure investors, particularly bondholders, that this matter is going to be resolved in a way that doesn't mean some kind of default, complete meltdown of Evergrande?
Hi, yes. Well, so we have not thought of Evergrande as a Lehman event. However, I think this bond payment, it became more apparent after they were able to successfully negotiate an extension of one of the private loans, what was called a jumbo fortune. And then following that, they also did pay the coupon of the renminbi bond. So it wasn't entirely a surprise, although when it was first announced that they would pay this last US dollar bond coupon, the bonds initially had a bit of a pop and then sort of very quickly came back down to almost unchanged on the day, which I think tells you what the market implies as, the potential recovery value of the US dollar bond, which may or may not be treated differently. It's very unclear how the restructuring ultimately will become. I think that it made sense for them to pay this just pretty much about a day before the end of the grace period in order to kick the can down the road while they figure out a comprehensive resolution to this whole saga. I think that what is clear for us right now is we haven't had enough precedents to reassure the market onshore and offshore will be treated equally.
Well, true. And fortunately, there haven't been that many incidents to set the precedents, right? What will, though, this ultimate comprehensive, that's what you just called it, resolution look like? Will it involve the government? Will it involve the PBOC, who seem to say they want somehow the private players involved to work this out?
I mean, we would guess that right now the decision making is not entirely in the chairman's hand anyway. So the payment of this coupon, I would assume, does involve the government, including the PBOC, in order to maintain stability of the whole financial system. I think that much is sort of clear to the market. I think the comprehensive plan is up to anybody's guess at the moment, but judging from some other situations this year, it's entirely possible that onshore and offshore negotiations may be handled differently.
Are there opportunities created with this idea of a localized ring fencing, or do you think there's an overestimation of how credit markets are going to recover from this?
If anything, I think there's been an overreaction across the market such that dislocations are very much there for people to pick and choose through and see who the survivors are. That being said, of course, tail risk has risen. Default rates now we would expect to rise as well. But I think that, there's been dislocations that are quite interesting, both across double B as well as select single B names. But certainly overall tail risk has risen in the property sector.
When it comes to what we saw a couple of weeks ago, which sort of really revived the fear of the opacity of some of these cross defaults and obligations that, are not on the books, right? Is that fear unfounded? Do you think that was an overreaction?
Look, I think that there is also a part besides the fundamental analysis. There's also, a technical impact on the market as there have been some portfolio unwinds and unwinds of structured credit products that were, with leverage included that had contained, property bonds. That said, as far as the pricing in of fundamental risk, it is the case that while the PBOC last week made some statements towards trying to stabilize the market and mentioned the offshore bond market in, as it relates to property sector. I think that the intention of the government still isn't, to kill the sector, but to maintain deleveraging, trend in the sector to contain risk. I think that we do have to recognize one thing, which is that property developers do have a harder time in the versatility of the funding. So they are less able to shift, cash from projects, excess cash from the pre-sales they have less versatility in that. And it's also the fact that our dollar bond market right now, because of the fear, we have sort of spiraled ourselves in the US dollar bond market such that it's closed right now for new refinancing. So I think the winners that will emerge are those that made contingency plan ahead and are able to either sell some assets or, I think it's really about the ability to ride through the next 6 to 8 months potentially to pay out of their cash balance, pay down their debt. So I think that's the separation of the winners and losers. The PBOC, I think, has shown that they will be pumping, they are pumping liquidity into overnight markets right now, rather than making any triple R cuts, for example. So I think they are adjusting their policies.